answers from a completely different angle to Johan's. I have much more of an operational background. I spent a number of years working in manufacturing businesses, working in a corporate advisory team that dealt with a lot of sale transactions, but also turnaround, restructuring, a lot of operational efficiency analysis and performance analysis. And these are all very different types of models to a lot of the valuation or M&A type models that a lot of you might have dealt with. Now we'll go into a couple of examples, and hopefully you can see how some of these things might be relevant to you also in line of work that you do, because as Johan touched on, you are often faced with questions that are from the left field. They're not in your line of specialization, if you'd like, and it is important that you have an understanding of a lot of these concepts and how these models may have been used by someone else or will be used in the future. So I guess, how do I use models? A lot of the work that I do is based around what is the best option for the future, given a finite set of resources, a finite set of options perhaps, and a finite amount of time. So I use my models generally for forecasting, and that involves a lot of cash flow forecasting. It also involves a lot of custom scenarios. For example, I was involved in a forestry venture, and the client at the time was asking to assess how a number of clauses might be included for investors to invest in their scheme, and how different structures for providing the returns to those investors might actually affect their cash flow over time, whether it was better to create returns on a quarterly basis, on a yearly basis, and whether things like the option to buy back those shares in those management schemes in particular structures, how that would affect the business. Now that's not something that is a day-to-day model, and not something that I will likely have to build again in the next couple of years in the near future. All of the concepts that we'll talk about are still relevant to building those models and building them well for whoever you're working for. So another big issue at the moment, pardon the pun, is big data. It's obviously becoming much more of an issue in today's world, with technology growing day by day and us having access to much more information. A simple example of this might be a retail store that is collecting information about its clientele, or for example government institutes that are looking to implement new solutions for traffic or for the train system. We're getting more and more data, and it's becoming more and more important that financial professionals know how to handle data. The next item that is critical to a good financial model is accuracy, and also the ability to create efficiency for whoever you're working for. Now, a lot of things that we model are things that may repeat, or things that you may need to manipulate for whoever you're working for. One of the most important points that you need to keep in mind when you're building models, and I certainly base my the work that I do around, is to ensure that the models that you're building can be easily used going forward by whoever needs to use those to make decisions. Now that might be based on structure, it might be a simple idea of identifying each of your assumptions, but it's certainly something that needs to be in the back of your mind at all times.
I guess there's an interesting point that Chris has just touched on there, which is that idea that in some situations we are building a financial model to answer a question, a specific question that we need to know right now, i.e. what is this company worth right now and what should we pay to acquire a business. But as Chris has been talking about, some of these operational models that we're actually trying to build so that they can be used for years and years to come has a number of different implications in terms of what we put into them and what we factor in, and how do we build something that on one hand, say, reflects the current situation really, really well, but something that if we're going to be using this model for years and years to come, say if it's a model that may be handed over to a client or handed over to somebody else, how can we build it in such a way that whatever the scenarios and situations going forward, that model is accurate enough, but also flexible enough to be able to take in new information and new values over time.
That's right. And you need to be aware of that need. It's almost the first question you should be asking whoever's asked you to make a model is, will you need to use this model again? Or do you want a quick answer, quick and dirty answer? And we'll get to how you can do one or the other. You know, the obvious one is obviously, and us modelers are horrible at it, and that's overcomplicating your models. But we'll get to that.
All right, so I guess it's really interesting to kind of see somebody like Chris, who's probably spent the majority of his time in front of Excel trying to model current situations, as opposed to, say, somebody like myself, where I've done a variety of different things, but every now and again, modeling really comes to the forefront of something that I have to do. I might spend a week pretty much plowed inside of Excel, but then I may not touch another financial model for a month. So again, depending on what career you would like to pursue, you're going to be interacting with financial modeling in different ways. But I just about guarantee it that whatever you do within finance, somewhere along the lines, you are going to come up against financial models, and the better you can understand them, the better. So I guess how do we go from knowing nothing to knowing something to maybe even knowing a lot? As Chris mentioned before, financial modeling isn't necessarily one of those things that is taught a lot. As I said, 56% of people classify themselves as being self-taught when it comes to financial modeling. So what I wanted to do now is to quickly kind of go through some advice that I guess we've experienced ourselves and we've also seen in a lot of other people that can really help you demystify this whole area of financial modeling, and to get an understanding of how best to try and cultivate an understanding of financial modeling, because it's not something that you will necessarily be taught, but you will certainly be expected to know it. Now, big places, big firms, particularly the big investment banks, and even some of the big accounting firms, the EYs, the Ernst & Youngs, etc., are likely to maybe give you some training along the way, but many places, particularly the small, medium-sized places, are likely to give you very little, if any, training, formal training when it comes to financial modeling. Most of your training and most of your learning about financial modeling is going to be dictated by yourself. So really kind of take this as a little bit of a wake-up call that if you're kind of sitting there, you're familiar with financial modeling, you know it's important, but you're kind of expecting somebody to one day come along and tell you when you need to start learning about it, that's probably not going to happen. Financial modeling is one of those things that the more proactive about it you can be, the better. And that doesn't necessarily mean go away and spend all your weekend studying financial modeling. But what it means is really throwing yourself at it. You're driving your own learning. So regardless of whether or not your company is going to send you on a financial modeling training course or not, you and the way you approach financial modeling is really going to dictate how you learn and how good you ultimately become at something like this. So one of the biggest pieces of advice that I think I can give all of you is don't shy away from complex models. And what I mean by that is that so often, particularly in those first probably 1 to 2 years of your career, particularly being a financial analyst, And I guess we've just run a poll here to kind of try and get an understanding of the audience. And 40% of the audience for this webinar is kind of 0 to 1 year's experience. So this is obviously very relevant to a lot of you out there. In that first 1 to 2 years, you are always going to feel like, I don't understand enough. I don't understand this model. There's so many complex things about it. And because of that, we get a little bit scared. And that's just a natural human reaction. You put a big, scary financial model in front of us as a first-year analyst, and we kind of go, oh, it's a little bit too hard. It's a little bit too scary. And I tend to try and sort of shy away or try and avoid some of those situations wherever possible. What I'm recommending is that we actually try and force ourselves to do the opposite. If you're working in a deal team and there's a big financial model that comes through, take the time to try and sort of rip it apart, understand little bits. Don't expect, particularly in that first 1 to 2 years, that you're going to go in there and you're going to be able to understand this whole model inside out and understand everything. That's not going to happen. And I know a lot of people sometimes want to know that, oh, unless I understand the whole thing, it's not worth kind of looking at. They write the whole thing off because they know they're not going to be able to understand the whole thing. What I'm trying to encourage all of you guys to get involved in doing is that if a colleague's working on a financial model, offer to help them out. If the model comes through and you're on the deal team that's working on it, or you're in a team that's dealing with a financial model, be proactive. Pull it up off the server, pull it out of that email that you were CC'd in on, and spend your lunchtime going through it. Spend your afternoon going through it. And don't try and understand everything. Just try and pick up on one little thread that you do understand and follow that through. See where it takes you. It's okay not to understand everything, but try to get into that habit of taking something that is really big, really complex, dare I say even a little bit scary, and try and break it down. Find that one thing that you do understand. If it's a three-way integrated model, start with a P&L. See if you can follow that P&L through. And once you understand that, then pick another little thread. Where did that sales figure come from? Is there a whole new page that explains the sales figure? And get into the habit of taking a big, daunting problem and just chunking it down and trying to understand a little bit by little bit. And even if in the first couple of years that's all you do, you just understand parts of models, that's going to be a really useful exercise when it comes to, by the time you're a sort of third, fourth year analyst or senior analyst or associate or whatever it might be, to have kind of spent that time looking at these models and try to start to follow the threads, follow how these numbers came to be, which ones are hard-coded, which ones are derived from other formulas. There's some fantastic add-ins out there that help you, what's called formula auditing toolbars or add-ins that help you trace where certain numbers come from. So get into the habit of taking something that you know you're not going to understand. That's okay. Don't be scared by that. Find a small little part of that model that you do understand and start to break that down and reverse engineer that. Because as I said, the more you understand, the more you learn, the more you understand. And the more you understand about financial modeling, the more enjoyable it's going to become. As it becomes more enjoyable, you're going to do more of it. And as you do more of it, you're going to learn more. And the whole cycle is going to repeat. So the earlier you can kind of get past that fear of, I don't know enough to start, I don't understand everything, the better. Just pick one little thing in that model that you think you might be able to understand and just focus on that. Ignore everything else until you get that first point. So Chris, you had a few other, I guess, suggestions when it comes to, we're even really talking about mindset here. What is the mindset of a successful analyst in those first few years?
Johan, if I can just quickly join you on that. You know, I think in my experience, I learned very quickly that the people that, my bosses, the people that were my audience for the models that I built, I learned very quickly that those people either are poor on time or poor on the ability to do these things. And so to continue on the stream of what you were talking about earlier, I think you're absolutely dead right to suggest that the more important thing in financial modeling is to be able to understand the mechanics of the model. The accounting theory or the financial theory will come with your experience, but what won't come with your experience, or may come slower or harder as you gain more responsibility and you yourself have less time, is that it will be harder to catch up on learning the mechanics of Excel or Microsoft Access or some of these other systems, and you won't have that perhaps the head start that you might have had if you had got used to actually using the formulas, navigating around spreadsheets, auditing and reviewing and tearing apart these models, even if you don't understand the finance or the accounting. Would you agree with that, Johan?
Oh, absolutely, absolutely.
So, in the same strain, there are a couple of basic principles which you will all be able to see on your screen now if you're watching it on your computers. That I think you need to learn how to do right from the get-go. These are the things that I think you should instill as my 5 most important points that I think everyone should remember when they're building a model, even if it is a 1-page financial statement that has almost very, very simple formulas in it and is not a 3-way complicated comprehensive model. You still should have these things. You shouldn't be hard coding numbers. You shouldn't be running assumptions on the same area as your outputs. But all of your models should be built with the outset that it is robust enough that you can hand it over to someone. You can not look at it for 3 months and then come back and perform everything in the exact same way. It needs to be accurate with the way that you actually structure your formulas to your inputs. It needs to be easily controlled by the end user, because a lot of the time it might not be you that actually controls this model and provides the analysis and provides the commentary. You might just be the guy who's been asked to build the model, only for it to be handed over to someone else to use. So that also means that as a more senior analyst or a more experienced professional, I will often ask people to build things for me. And having said that, I still need to be able to easily review it so that I am confident in the outcome. I may not have the time to spend a week building my own model for a particular reason, but I still will take the time to make sure that it's right, that the outcomes are accurate and correct, and that from a logic point of view it makes sense. And I'm a much happier supervisor or manager if the models that my analysts build for me are simple to review, with clear instructions, clear assumptions and outcomes, and professionally presented in a clear, easy to read format that makes me think that that analyst is professional, is clear and good at what they do generally. There's no reason why you can't do that in your first year without any finance knowledge or any accounting knowledge.
No, it's a very good point. So look, I guess what we wanted to do now is perhaps run through a few different kinds of financial models that you might come up against. What we often see for people who, even regular financial modelers, is that they tend to get very good at doing a certain form of financial modeling. But there are a whole variety of different kinds of financial modeling out there, a whole bunch of different kinds of questions and different kinds of problems that they might solve. So I guess we've picked 5. This is by no means an extensive or exhaustive list of financial modeling, but this is kind of 5 common sort of different areas. So we're not going to go through in-depth case studies, but we wanted to kind of give you guys, because I know we've got people in this webinar that come from a variety of different backgrounds and a variety of different stages of their career, just a really quick snapshot of the different kinds of financial models, the different kinds of things that you might see along the way in your career, and to give you perhaps a little bit of a better understanding of when these things might be used, roughly what they look like, and what kinds of questions they might answer. So, Chris, did you want to take us through perhaps the first one, the 3-way financial model?
Sure. Look, I might just, before we do that, I just saw a question come through, and please, if you're watching this, please give us your questions as we go through this. We're more than happy to answer them as they come through. We will try and answer as many as we can at the end of the session. But look, you know, I saw a question come in from Sebastian. Thank you for your question. Look, there are, as I said, a lot of people aiming for these top-level jobs in investment banks or corporate advisory firms around the industry. And I think interviewing prospective people as well, you know, one of the things that I will look for is someone that is not necessarily confident to tell me that they know the answer, but has all those traits to be self-driving, to learn on their own, as we've spoke about, but also to be logical, to have commercial acumen. So not just caught up in the models, but also caught up in the details, and to be able to step out of the model and with fresh eyes look at it and say, look, you know what, that doesn't make sense. There's got to be a problem in that part of the model. I'm going to go and find it and give it to and give it 2 minutes and fix it, so that when I do present something to my supervisor or my manager, I can honestly look them in the eye and say, I've looked at this with the big picture in mind. I haven't got caught up in the detail of building a brilliant financial model that has all the bells and whistles that will, you know, make coffee and bring you lunch. That attitude is really important. So I think, you know, all the skills in the world help, but the attitude and the way that you approach these models should be the way that you approach your general day-to-day work ethic, that it's well thought out, it's detailed, it's accurate, but also has the big picture in mind and is not overcomplicating the issue. Let's just remember that through this whole process.
Yeah, and I think that's a really important point that Chris brings up. It's that inquisitive mindset.
That's exactly right.
Don't assume that you know the answer, but you're intrigued in terms of how I'm going to get there. You're going to keep digging until you find it. That's much more important than trying to come across as, I know everything there is to know.
That's right. Anyway, let's move on. So we're looking at the moment here the idea of a 3-way financial model, and for those who aren't familiar with 3-way financial models, they're essentially a suite of financial statements. The professionals that have had some experience will be very familiar with these. They're the suite of the profit and loss statement or the income statement, the cash flow statement, and the balance sheet. Now there are those who are starting out in the finance accounting industry will know that your revenue and your expenses are in your profit and loss, your assets and liabilities and your equity items are in your balance sheet, and those items that affect your cash from either of those other 2 schedules will make up your cash flow. Now, one of the most important systems that a business uses to measure its current state or its current position, and also the forecasting, particularly with cash flow, is to adopt one of these 3-way financial models. You know, obviously, your profits that are generated through a period affect your retained earnings in your balance sheet, and also you have your cash effects which run through into your balance sheet as well. All of these things need to be considered, and it's probably something that would be my first point of call. If you're looking for a starting point to go and do some research and work out what the first question you're likely to be asked when someone says, do you know how to do a financial model? The three-way financial model is the first point of call. Would you agree with that, Johan?
Absolutely. It's the foundation for many things that you can do with financial modeling. It's a really good core skill to develop early, and if you can really deeply understand the three-way, many of the other things that you're going to do from there will really flow on from your understanding of a good three-way financial model.
That's right. If you have this in place, some of the things that we'll talk about, scenarios, sensitivity analysis, your business valuations, cash flow forecasting, as I said, all of these types of scenarios, M&A, both on the buy and sell side, will ask for all of these statements. And if they don't balance, it raises questions about the validity of the accounts. It's not just about the validity of you and your ability to model, but it can also jeopardize. I've seen this in multi-million-dollar deals where the quality of accounting records has actually affected the buy or sell price because of the inherent uncertainty in the accounting records. So it's really important that you know how to do this. You don't want to be blamed for having bad systems in place or bad accounts. So I'd really encourage everyone to go and make sure they have a look at a good three-way financial model and get to know it. There are a lot of examples around. I believe one of the questions from Modeloff last year involved a three-way financial model, albeit a basic one.
So actually that's a good point, Chris. One of the questions that's actually just come up, what are some good sources for students that can start digging into different kinds of financial models? We're going to touch on Modeloff and the Financial Modeling World Championships in a moment, but I just wanted to flag it now, given that you mentioned it. We released the questions and answers to a lot of the previous year competition questions. Therefore, so if you actually go to the Modeloff website, there's a section there for 2012 questions, and these have a number of the case studies as well as the work solutions. So if you're looking for some free resources, they're up there for anyone. Download them, share them with your friends. It's all free. That can actually be a really useful source, particularly for students and people in the early stages of their sort of finance careers, where they just need a bit of guidance as to some real-world sort of financial models. Not the kind of, sometimes, not all, but I don't know, in some textbooks, things can sometimes be dumbed down to be a little bit too simplified. And it's great to help you understand it, but it's not a real-world example of a financial model. Whereas a lot of the stuff that we try and sort of put in Modeloff is taken straight from investment banking experience. So, to answer some of those questions in terms of where's a good place to start digging, obviously...
From there, Johan, I would also encourage people to have a look at the books written by Simon Beninga and also Bill Jelen, who's the Mr. Excel. Both of them are actually involved with Modeloff as well. They're on our judging panel for the competition, but they also publish very, very good books. Simon Beninga follows the investment banking logic and theory, whereas Bill Jelen's work is more around the actual mechanics and best practice of building the structure of a model and using Excel formulas and VBA, Visual Basic, for applications, which we won't touch on here, but I encourage you to go and have a look. All those details in terms of if you've missed those names are all on the Modeloff website.
So Chris, should we keep going through a few of these different examples? Because I want to make sure there's a little bit of time at the end for some questions and things as well. So take us through the next sort of model that you wanted to talk about?
So the forecast. So as I said before, the three-way model leads us into what are we going to look like in the next month, in the next 6 months, in the next 12 months. A lot of businesses will focus on the next 3 years, 36 months. But having said that, businesses can forecast things like capital expenditure out for 20 years. And likewise, they can also have rolling forecasts. They can, probably in my experience, most businesses have at least 3 years to 6 years with a detailed forecast for at least the next 18 months or 24 months. From there, the forecast branches into what's called scenario analysis or sensitivity analysis, which essentially looks into how your business might look if a number of the assumptions that you've used in your cash flow forecasting have not reached their targets. For example, sales. Sales is the obvious one. So let's assume that a business is based on, 5% or 3% increase in sales over the next 24 months, every month or every year. A business might base that assumption on, say, the introduction of 2 or 3 new offerings, 2 or 3 new products in their range. Let's say that they assume basic sales for the first month and then ongoing growth from there. The sensitivity analysis, in a simple point of view, might say, well, we need to make at least 80% of that target in order for us to make a profit on this venture or break even for the next 24 months. Now, you can see the importance in this if a business has large amounts of debt which they have to service, and how, especially given the global financial crisis that we've had in the last 5 years, and rumours that ever circulating rumours that we might be due for another one. You can see how a business's bank, for example, might be interested in seeing that kind of analysis and knowing exactly how your initiatives to make money over the next 3 years might be sensitive. Obviously, there's things like the cost side of it. There's also things like how currency might affect your key suppliers in a business. Agricultural businesses that rely on grains or other food ingredients, or the obvious one is also mining businesses that have huge variability in the price of their produce. A lot of the time those assumptions can be quite volatile. Say, for example, an ore producer, how much is a ton of ore going to make me over the next 24 months?
Forecasting models can be very, very complex, and there's as Chris mentioned, it can fork into so many sort of different directions. Let's, Chris, perhaps just quickly run through, because I know there were a few others that you were keen to sort of touch on before we run out of too much time. Yes.
Let's keep going. So the next thing that we're looking at is the operational performance analysis. So the sheet there, just while we've got that picture up, is what's referred to as a dashboard. And it's a really useful one-pager that would be presented to a board of directors or a management team to give them basically a one-page view of their business and the key drivers in their business. So some of the things that might be involved at this stage would be a variance analysis. Now, you might have heard of the ideas of a price variance or a volume variance. Now, they're pretty self-explanatory, but for those who aren't familiar, one is the difference in the margin that you actually get from what you're selling, and the price that you're able to achieve on the product. And the other one is how much volume you actually are able to generate over the next month, or if you're looking in terms of current performance, in terms of what you made in the month just gone. There are a number of ratios which people use, things like working capital ratios, creditor turnover, or just general cash turnover, which is also often called debtor days or creditor days, cash days. Now that, for those who aren't aware, is very different to the average days of debtors, which is how much a debtor is outstanding across terms, whereas debtor days is a measure of how much cash is locked up in your business. So it's a historical measure as to how many months of sales, for example, are locked up in your balance sheet. How much cash is not available for you to use right now. So these sorts of analysis all come out of the elements in your three-way model, your balance sheet, your profit and loss. And if you look on the other side, things like EBITDA, or return on assets, return on sales, they'll also lead into things like your mergers and acquisitions type processes, working out, for example, enterprise value. A lot of people will use an equity multiplier in a lot of analysis as well, which comes out of all these things. Now, in the real life world, you would build your three-way model. You would maintain that week by week or month by month, as it might be, and run these kinds of ratios or run these variance analysis week to week, and provide, say, a one-page email or a one-page report to your manager so that they can have all the information they need up front to make the decisions they need. They might look at it and say everything is perfect, nothing to do here. But you'll always be ahead of the game if you can build a template like this for your business and present it to the people that need to know on a regular basis, even if they don't ask for it.
Okay, excellent. Chris, did you want to just really briefly touch on the last two that you had here?
Right, so mergers and acquisitions transactions, and that also includes divestment, which is the sale of a business. This is the sort of work that you'll often see in the large investment banks around the big cities. They're the guys who do a lot of the legwork for businesses in those confidential situations where a big business is looking to buy another business, or alternatively, a business is looking to sell off one of their businesses. And that's what's referred to as vendor due diligence, where a business is looking to sell a business, but yet they don't have the time to basically do the selling. So they'll hire someone like, PricewaterhouseCoopers, for example, to come in and sell their business for them, essentially. And that would involve you to do all the same analysis that you would in the due diligence process for the business that you're buying, but rather do it for the business that you're selling. And what the most important thing there is to identify the needs of all of your prospective buyers. Now, a big element of this is market research, which is probably not as relevant in a lot of the other stuff. So a lot of the potential buyers in the transaction may have particular needs or particular concerns depending on the industry. One of the biggest objectives here is to identify what that question is. What is the biggest needs of those businesses, preempt it and anticipate it, and model all that information for them before they ask for it, so that you can give it to them when they want it and effect the sale quickly without delaying anything. Now, part of that, the M&A process, is also the valuation of a business. Now, there are a number of ways that people do valuations. Without getting into too much detail, You can value a business based on its assets. You can value a business based on market value. And you can value business based on its income streams. Now, market value is probably the one that you see most often. It's a bidding process between potential buyers. The asset process is what you generally use if you were selling a distressed asset. So a business that maybe isn't doing so well and doesn't have an active market to sell. Things like post-sale adjustments. When you're selling a business, often the time frame that you have to sell a business is much shorter than what you realistically can pull all the information together. Things like stock. If you look at multi-million-dollar multinational businesses, often the inventory of the business is the hardest thing to quantify. You might have all sorts of things like obsolete lines. You might have stock that is on the balance sheet that simply doesn't exist. In that situation, there'll be a post-sale adjustment between the two parties that will balance off the purchase price at the end of the day. Often that is one of these quite extensive big data analysis where you really need to have a grip on how to manage that much data and quickly sort out the trash from what's relevant. Things like NPV and synergies are really interesting. A lot of the time when a business is looking to acquire something, it's looking to acquire it because of some kind of strategic benefit. It's looking to acquire that business because it might have a joint benefit. This is something that personally is really interesting for me. This is where I do a lot of my work, as well as the operational stuff. But working out exactly what the benefit is of a business joining with another business, and a really simple example is, say, an industry where there might be one large contract owned by a business, where the acquirer has a second large contract from the same customer, and there may be a third large contract that same customer has somewhere else in the field. By acquiring that business, they now have 2 out of 3 of the main available contracts, and it's only a short step from there that because of the cost saving that the client will realize by shifting that third contract to the buyer as well, it's something that the client can't ignore. So often there's a model that's built to identify all of those synergies that will result from acquiring a new business. So that's a really interesting one to think about if you're looking for a direction.
Yeah.
Now, in terms of, there's a question here that's come through from James. What are the opportunities for private practice consultancy in financial modelling? Well, the answer is lots. There's lots. I mean, what we said right at the very start was that financial modelers solve the problem for people who don't have time and people who don't have the ability. And that's can span across all of these areas. So everywhere from those large investment banks all the way down to the small markets, the mid-market, it applies everywhere. And there are consultancy businesses at all levels. So look, if you are looking to get into the big consultancy practices, I would encourage, and you're not having any luck, I would still encourage you to look at some of the smaller ones. There are some really good small consulting businesses that have actually branched off from those larger ones. And so a lot of people have that misconception that because it's a small consultancy business, it doesn't have the same quality and it doesn't have the same learning and development that you would have in a big firm. And that's simply just not right. That's wrong. You will have opportunities in big business, but there are a lot of partners in large businesses that branch out into smaller consulting firms, and you can really actually get more exposure in some of those businesses in some cases, because it's a smaller team, and potentially you're required to be more senior more early. You do get some really good exposure. So I'd encourage you to try and still go to the smaller consulting businesses and do your research to work out which ones have potentially come originally from those larger consulting businesses, because they're likely to have similar networks.
That's good. Thanks for that, Chris. So look, moving on briefly, I wanted to kind of give you a quick brief overview, and I know a few people have kind of raised in the questions, what is Modeloff? What is the Financial Modeling World Championships? The Financial Modeling World Championships is essentially a competition that we've been working hard to put together, and very appreciative of support from people like sort of EduPristine to kind of help spread the word. But this is one of the ways that I guess we're trying to tackle that issue of, financial modeling is often overlooked. It's not something that's talked about that much, but it's everywhere you look in finance. You can hardly spend a year working in just about any role in finance without having something to do with financial modeling. So we thought, wouldn't it be great to put on a competition where people at all levels can get involved, whether you're a student looking to improve your skills, all the way through to more senior people that have had maybe 3, 4, 5 years experience financial modeling and really want to try and sort of prove that they've got what it takes to be the best in the world. Our solution was, why not run a fun international competition? So that's what we set up. And Modeloff is structured as 2 online rounds. So round 1 for the 2013 Modeloff starts on October the 26th, and it's a 2-hour online contest. We'll take you through a variety of different questions, scenarios, case studies, where you'll be given some information, and then you'll probably have to go off, build a financial model, and answer some questions from it. There might be other scenarios where you've got to do some abstract problem solving. Maybe you'll have a model and you've got to find some errors in it. So it's our way of trying to make financial modeling a little bit more accessible, a little bit more fun, and something that you can actually get involved with. It's not something that you just have to wait for the right kinds of transactions to come along. Here's a fun, interesting way to get involved. So the competition is structured as 2 online rounds. We then have a live finals in New York. So the top competitors after the 2 online rounds, actually we fly the top 16 to New York for the finals, and there's a big cash first prize of $30,000 US for the overall winner. And if you think you have to be really old and experienced to win a competition like this, keep in mind that the person who won Modeloff last year was a 24-year-old from New Zealand. So it's one of those things that don't assume you have to be in your 30s or you have to have many, many years experience. Financial modeling is one of those things that's picked up by many different people at many different rates. So look, it's a fun way to develop your skills. It's a great way to get exposure to lots of different kinds of financial models. And it's a way to have fun with your friends. Now, the competition itself, there is just a small entry fee, which is $20 US for students and $30 US for professionals. But for all you guys involved in the webinar today, we've set up a discount code for you guys so you can actually sign up with a 50% discount. So take a screenshot, write down that discount code, put it in your phone, do whatever you need to do, hold on to that discount code, because if you would like to sign up in the next 2.5 weeks before round 1 starts, make sure you use that discount code and you'll get half price entry. Now, there's also been a few other questions that have been coming through in terms of various opportunities for resources. Where can I find some lists of this? Where can I find some books? Who were those authors? Do you have any recommendations for different kinds of sites? On the Modeloff website, there's actually a resources section there, and that's got a whole different variety of recommendations for books. It's got a variety of Excel add-ins. There's a whole bunch of resources there that if you're searching for where to get started or where's the next thing that you might want to latch onto to try and help improve that learning process, go and have a look at that Modeloff resources section. Obviously, companies like EduPristine have a variety of more sort of formalized training programs that, depending on what stage of your career you're at, they may be really useful and valuable. So I'd certainly look at things like that as well. But even just getting involved in things like financial modeling and the Financial Modeling World Championships, it's another way to help push you forward again. It's another way to, as a result of this, you'll understand a little bit more, and then next time you come across a financial model, it's going to be that little bit easier. Things like this also look really good on your CV. There's a whole variety of finance competitions out there. There's the CFA Research Challenge and many of these other ones. Employers really look favorably on this kind of stuff because it shows that you're proactive. It shows that you're willing to kind of put yourself out there and learn proactively and hopefully have some fun along the way. So look, before we get into a really quick Q&A, we just wanted to kind of cap off or round things off with a few sort of very quick tips and tricks that we might recommend for anyone who's kind of at that stage where they've done a little bit of financial modeling, but really trying to say, all right, well, what are some tips and what are some recommendations to help me take that next step forward? And Chris, did you want to perhaps quickly just run us through these suggestions that you've put together?
Sure. Look, I mean, there are a lot of tips and tricks that people will have. I mean, everyone has their own tricks. There's actually, Bill Jelen last year actually interviewed each of the 16 finalists and recorded a podcast of each of their tips and tricks. So I would encourage you to have a look at that at some point. There are some very true, some very clever pieces of advice in there. But a couple for you today, just which might be a little bit broader. The keyboard is one that is always a point of contention with financial modelers, but I think if you can get to know the shortcut keys for Excel, it does allow you to move a lot quicker around a spreadsheet. I think with more accuracy as well using the mouse, but it also in learning all of those, it also allows you to get a much better feel of what Excel is capable of, all the commands that it can do, for how you can move around, things like using Shift and the arrow keys to move in any direction to the end of a data set. Things like using Control tilde to view the formula behind a sheet to find any error, or things like adopting something like Spreadsheet Studio, which is an auditing tool, which Johan mentioned earlier. Things like that can be really handy to actually get the most out of Excel. I encourage you to have a look at sort of what shortcuts are available for Excel, and also what shortcuts and add-ins you can adopt to even further extend the power of Excel. In terms of your models, we've already touched on things like keeping your model robust, so that you can't break it or anyone else using it doesn't break it. One of the ways to do that is to make sure that when you're using your model, you keep your formulas consistent. So find ways to use the same formula in every cell. It'll save you having to look for errors. It'll save you having to find out where something's broken, because your entire page will be broken if your formula is wrong, not just one cell. There are things like, let's say you had a data set with the 12 months of the year. Rather than having your formula refer to one cell, say column A, and then having your next column refer to column B or column C and D and so on, you could apply something like an offset formula, and this solves the problem that a lot of you may have come across from time to time, where financial modelers will use a spacer column in between each of the months. So what that means is the month appears in every second column. So, for example, column A, column C, column E. Rather than having to program the letter A, C, and E into each of your formulas, you can build your formula so that every single formula refers to column A, and you use the offset formula to shift by the number of months across by 2, for example. Now, that may not mean a lot to you right now if you haven't used the offset formula before, but go and have a look at it, think of it in that way, and you might see what I mean by that. I think this webinar is being recorded as well, so keep that in the back of your mind and have a look at it next time you're working with 12 months of data. Now, the other thing as well is that guys who, when you're building large models and things are getting a little bit expansive, often you'll find your models slow down, and no one likes sitting there waiting for Excel to recalculate every 5 minutes. These are some of the things that are doing that to your model. So things like array formulas, user-defined formulas, data tables are a really big one that drags a lot of resources for Excel. Conditional formatting can often take a file from 3 megabytes up to 12 megabytes in no time. And hyperlinks as well will do the same thing. So have a look if you are having problems with your Excel file being too large or too slow. Maybe have a look for some of those things and see if you can break the array down into 2 lines so you don't need to use the array, or whether you really need those formats or hyperlinks.
There's some really good tips. Chris, you mentioned on whether or not this podcast, this webinar is being recorded, and yes, it is, and I believe it's going to be made available in the sort of coming days or weeks. We might be able to grab a few details of that just at the very end. But yes. I think, sorry, did you want to just answer that question?
No, I just wanted to add that yes, we would be uploading this webinar on YouTube, and the slides would be available on SlideShare. So in case anyone wants these, they can refer to those respective sites. And in case need be, you can still mail it to me at yashu@eneve.com. Yeah, that's about it.
Excellent. Well, look, I know we've probably already gone well over time. There's just a few really quick questions that have popped up here that I think might be worth coming back to. One comes in talking about, is this branch of finance regulated? And
question.
Are there kind of compliance tools and sort of bits and pieces as well? And look, I'm going to throw over to Chris in just a moment, but look, the simple answer is financial modelling itself is not regulated. Financial modelling is a bit of a combination of an art and a science. There are some different practices, etc. I might let Chris talk a little bit more in terms of some of the standards that are out there, just briefly, because I know we have kept you guys well past the allotted hour that we have, but given that so many of you are still tuned in, clearly there's some interest in what we're here to talk about. So, Chris, do you want to just maybe give a really quick sort of 1 to 2 minute overview of some of the standards out there and the way kind of compliance plays into?
Yeah, there are. You're absolutely right. There are a number of different. Sets of standards. There's the SMART standards, the FAST standards. There are a number around the place. There is no definitive set. It's the short answer. No, there is no authority on this. Nobody has released any set of rules that has been adopted by any of the accounting groups. There are groups of people who believe in each one of them, obviously. We've tried to isolate those for the Modeloff competition. There is a set that you can download from the website that identifies some of the basic rules that I think are generally accepted, and they're things like having your assumptions in a different area to your outputs page, things like not editing in the cell, but editing in the taskbar, in the formula bar. Things like, well, a lot of people will use a formatting guide. We haven't applied that with Modeloff in terms of blue font, black font, green font, purple font for various types of for example, cells using formula from an ultimate page, cells that are hard-coded, assumption cells. Other than the assumption cells, it's very good practice, but it's also you know, something that a lot of people have different opinions on.
We have a general style guide for the competition, which is a way of encouraging people just to get into a good habit. But that's about it.
Yeah, look, there are 10 or 15 points there, and they're on the website. So rather than going through them all now, go and have a look at them. A lot of them you might find that you're already doing, but it's probably a good thing to print out and sit next to your desk at work, and just remember to keep doing that as you're building things.
Yeah, excellent. Well, look, I know there's still more questions rolling through. We might see if we can get back to those people individually via email and bits and pieces. But I think we might wrap it up there. I'll throw it back to you, Yoshini.
Yes, we might just.
Yoshini, did you need to say anything before we wrap up the webinar?
No, I just would like to say that it was a great webinar, very informative, and no, that's about it. In case you have something to add, you might just.
So, Johan, do you want to give the guys the email as well? If they have they need to contact us?
Yes, certainly. Now, what's
or
the best way
or is it best that they contact Yashu?
I can do it. Yeah, look, for any inquiries regarding Modeloff, the competition, how it works, anything like that, there is an email address which I'm going to put in. You should all see that there's a chat feature in this GoToWebinar. The email address is just info@modeloff.com, and I'm going to put that in the chat feature now, info@modeloff.com. So if you've got any queries or want to ask any questions about the competition, any of the resources that we've mentioned, feel free to email us at that email address, and Chris or I will certainly get back to you. In relation to the EduPristine courses and bits and pieces, Yashu, it's probably better to be directed towards you. I know a few people were asking your email address. Did you perhaps want to just quickly put in your email address to the entire audience as well?
I think I just did.
That's on the slide.
Oh, perfect.
Yeah, I think I just did.
Excellent.
Okay, so I think that brings us to the end of webinar, and thank you everyone for attending the webinar.
Thank you.
Thank you, everyone. It's been fun.